Guys, now it is very important that you are with me and that you understand this calculation. When you look at 2009, our total temporary difference is 154,545, and this is a taxable temporary difference. For 2010, our total temporary difference will be the 1198900, also a taxable temporary difference. You should be able to calculate the movement, and important, the movement of your total temporary difference from 2010 versus 29. Now, when you look at this, 2010, we had a taxable temporary difference of 1198909 minus a taxable temporary difference of 20.09 of 154,545, resulting in a total movement of 1044364. Now guys, bear with me, this is important. Go. Now that total movement, you should be able to divide into the movement relating to your profit and loss, the movement relating to your OCI, and number 3, the movement in terms of your unused tax loss, either being created or utilized. Now we will look at this in our next IAS 12 lecture in detail. But this is the basic principle, and this is one of the most important principles that I identify students struggle with. Now, when we look at the movement of our OCI first, this is our easy section, movement of our OCI. And this is the reason why I have explained to you when there's a revaluation surplus that it will hit our OCI. When you look at 2010, we had a revaluation surplus on land A, and this was 200,000. Then on our factory building, we had a revaluation surplus, temporary difference 160,000 and our 750,000. Therefore, the total temporary difference that moved through our OCI for 2010 will be the 1110333. Sorry guys, 1110000. Okay, therefore, when you include your calculation, this will be your 200,000 plus your 160,000 plus your 750,000. Okay, and this is a taxable temporary difference. Important. Then, the next thing that you should be able to identify is the movement in terms of your profit and loss. Okay, so guys, this is your movement of your profit or loss. Therefore, when you look at 2009, all of your temporary differences relate to profit and loss accounts. Therefore, we have indicated, look at the right side, deferred tax liability profit or loss, deferred tax asset profit or loss. Therefore, this is the 154,545 amount, taxable, and this will move to the total of our temporary differences of 2010, which is taxable 340,909, deductible 72,000, and deductible 180,000. Deferred tax asset also through our profit and loss. And when you look at the right side of your screen, I've included the calculation. This is a total of 88090. Therefore, minus 88090. And you need to identify that this is a decrease in our taxable temporary difference. Okay, guys, look at this. Taxable temporary difference was 154,545, and now it is 88,909. Therefore, this is a decrease. Okay. Now, you are able to include your deferred tax portions. Movement in our profit and loss. The deferred tax is 18378. and the movement in our OCI is 310,800. Okay, so guys, this is important. You need to ensure that you understand this. Now we need to transfer the movement of our profit or loss to our current tax calculation. And this will be the temporary difference movement, the 65,336. Okay? But guys, before we do this, I just quickly want to look at your journal entry, because then you will be able to understand the current tax calculation. So when you look at your journal entry, our deferred tax move from a deferred tax liability of 43,273 to a deferred tax liability of 335,695. Remember, this is a liability. Therefore, this is an increase in our liability. An increase in our liability, journal entry will be to debit your deferred tax in your profit and loss and to credit your deferred tax liability in your statement of financial position. Now it is important that you understand the transfer of our movement in our profit or loss to our current tax. This is our current tax. We now need to include the 65,636. But do we include brackets or not? This should be a positive. Now why? Back to basics. Think about your journal entry. We debit our deferred tax in our profit and loss, and we credit our deferred tax liability in our statement of financial position. Therefore, we provide for a possible future tax. If we provide for future tax, we need to increase our taxable profit or loss. I'm also going to explain it to you this way. Now I want to explain to you a very important principle that I want you to be able to identify. You will remember during our lectures that I've explained our taxable profit as follows: that you need to obtain your accounting profit or loss, identify all of your reconciling items, and calculate your taxable profit or loss. Now, your reconciling items will either be exempt differences or movements in our temporary differences. Now, when I refer to exempt difference, guys, not really exempt as in the word exempt, but this will include your non-taxable deductible items. Your temporary differences, you will be able to trace back to your deferred tax calculation. Now, what do I mean with this? If you look at the reconciling items, now remember, we've indicated that our reconciling items will be one, other expenses allowed for accounting, not for tax. Two, expenses not allowed for accounting, allowed for tax. Three, income allowed for accounting, not for tax. Four, income not allowed for accounting, allowed for tax. Okay? Remember, this is your accounting column and this is your tax column. Now, these expenses can either only have an effect on our profit or loss, such as depreciation, admin building, or this will have an effect on our profit or loss and our statement of financial position. Now, when you look at your deferred tax, remember, for our deferred tax, for each separate item, we had to either deduct our depreciation or our tax allowance. Now I'm going to start to include all of this because I want you to be able to identify exactly what I mean. If we look at our factory building, we could deduct our depreciation, and this was an amount of 250,000 for accounting purposes. Therefore, we need to add this back. Then our tax allowance, we need to deduct 250,000. Then our next asset will be our machine. Same principle with our machine, guys. For our machine, we had our depreciation and we had our tax. Now you can refer to all of our calculations. I want to explain the principle to you. The depreciation, 204,545, and our tax portion was 340,909. Then when you look at our deferred tax calculation, you will remember we had a provision in terms of our repairs. Now guys, this is important to think about this one. When you refer to our tax calculation, in 2009 we had a provision of 50,000. But we may now reverse that provision. Why? Because we've actually paid the amount in 2010. Therefore, if we have actually paid the amount, we have 200,000 outflow and 150,000 that we need to take out, reverse. Okay? Therefore, in our current tax calculation, in terms of our repairs, you think about this, guys. For 2009, we've debited the expense, we credit our provision for 50,000. Now, in 2010, we debit the expense with a 150, the remaining portion. We credit our bank with 200,000 and we debit our provision with 50,000. Therefore, the actual outflow will then be 50,000. 200,000 minus 150. Okay? Then when you refer to your deferred tax calculation, you will remember for 2010, we had the provision, the 72,000, and our revenue received in advance, the contract liability. In our calculation, we have our contract liability. This is the 72,000 that we can add back, and we have our income received, the 180,000. Therefore, when you add all of this, you will identify that this is a positive 65636. This is important to identify. Therefore, when you go back to basics, when we talk about our reconciling items, being the difference between our accounting and our tax rules, you will identify that we include the movement in our temporary difference relating to our profit and loss. Okay, now we are able to calculate our taxable income, and this will be 1,398,136, and our tax at 28%, 391,478. And we now need to transfer this to our income tax expense note. Remember to indicate that this is your calculation number 1. There were no under or over provisions, and we now need to include the movement in our temporary difference in terms of our profit or loss calculated in our deferred tax calculation, therefore calculation 2. Okay, so guys, now you need to ensure that you understand. When you refer to your deferred tax calculation, look at the bottom. Remember, we've calculated the movement in our profit or loss, 65,336, taxable temporary difference, and this is now 18378 deferred tax. Okay, but guys, in our note, I'm going to transfer this and then I'm going to explain the signs to you. 18378. Remember, this is only your profit or loss portion, and now we need to include brackets. Okay, now the question, why the brackets? When you refer to your deferred tax, remember we are only looking at the deferred tax that has an effect on our profit or loss, not the OCI. Therefore, if you add 20.10's deferred tax, this will be, when you look at the right side, 20895. Now, this is the deferred tax liability for 20.10, only relating to the profit and loss section. Therefore, this is a movement from a deferred tax liability of 43,273 to 24,895, and this is a decrease. Okay, this is a decrease. Therefore, in your note, you need to include your brackets because this is a decrease. And your total income tax expense will be an amount of 373,100. Now, our next important step, we need to remember our tax rate reconciliation. Now, please, with your tax rate reconciliation, and include a note, you do not include your temporary differences, movements, okay? We need to include our accounting profit, and you can refer to calculation 1. In calculation 1, we have identified that this will be the 1,550,000 minus the 2,500. Therefore, this will be an amount of 1,547,500. I'm going to call this calculation 1.1 for my marker to be able to identify. Indicate calculation 1.1 in your note. And this is the amount of 1,547,500 times 28%, and this will be 4,333,300. Now, for your reconciling items in your tax rate recon, you can use your current tax calculation as your guideline. Therefore, in your current tax calculation, I will transfer my dividends received, the fines, the depreciation on the admin building, and the profit on the land sold. And I will transfer all of these amounts to my recon. I've transferred these amounts, then times 28% each of them. Of course, this is our recon in terms of our effective tax rate. An important thing that I want you to be able to identify, the profit on the land, which is our 40,000. I've transferred as is the 40,000 from my calculation. But you need to indicate to your marker that you did calculate this in calculation 1. And we can add all of our amounts. Our depreciation will be 7,000 that we need to add back. The dividends received, we need to take out 58800. We need to take this out. The fine will be an amount of 2,800 that we need to add back, and 11,200 that we need to take out. Then there's no effect on different tax rates in terms of foreign income. There's no unused tax loss. There's no under provision, and there's no change in tax rate. We will look at all of this in our next IAS 12 lecture, and we can include our income tax expense 373,100, and this reconcile to our note. In requirement B, we need to calculate our SARS payable balance at the end of 31 December 20.10. In note 8, they've provided us with our SARS payable account, first provisional payment of 110,000, second provisional payment of 70,000. On a new page, I will indicate that this is my part B, and I will make use of a T account. Why T account? As I prefer to do this with calculations. Now, our provisional payments, you will remember, your journal entry will be to debit your SARS payable and to credit your bank. Therefore, on the debit side, I've included my 110,000 and my 70,000. Now, when you refer to calculation 1, our current tax, our journal entry to recognize the current tax 391,478 will be to debit your current tax in your profit and loss. Now guys, this is technically part C of this question. And to credit your SARS payable account in your statement of financial position. Therefore, I've transferred this amount to my T account. On the credit side, an increase in the payable, and the balancing figure will be 211,478, and this is my outstanding amount that I need to pay to SARS in terms of the current financial year. In requirement C, we need to prepare the deferred tax journal entry for 31 December 2010. Therefore, guys, not our current tax, as I've mentioned in our previous recording. This should be our deferred tax. Refer to your deferred tax calculation. Now, important guys, again, when you look at the movements at the bottom, the total movement from a deferred tax liability for 2009 of 43,273 to a deferred tax of 335,695 will be 292,422. But this movement is divided between our profit and loss portion and our OCI portion. Therefore, our journal entry will be to debit our revaluation surplus in our OCI. Just move the screen a little bit. With an amount of 310,800, which we have calculated when you look at the bottom, guys. 310,800 brackets, therefore debit your revaluation surplus, and we need to credit our deferred tax in our profit and loss with an amount of 18,378. You will remember we did discuss this when we transferred this to our income tax expense note. And we need to credit our deferred tax liability in our statement of financial position. Remember, no abbreviations, guys. And this will be 292,422, which is our balancing figure. And this amount agrees to the 292,422 that we have calculated at the bottom. Now, when I indicate no abbreviations, yes, you may include abbreviations in terms of OCI. This is allowed. P&L, profit or loss, and SFP. But you may not include RS for revaluation surplus, DT for deferred tax, or DTL for deferred tax liability. You need to write out these words. Great, guys. We have now completed this very comprehensive question. Please ensure that you refer back to your problem areas, that you understand everything in this question. I think that this is a very good question to ensure that your basics from a third year knowledge is up to standard.